Hello everyone, welcome to Business School 101. Have you ever wondered how businesses keep track of their money? Or how investors decide whether to buy or sell stocks? Well, the answer lies in financial statements. Financial statements tell the story of a company's financial health, what it owns, what it owes, how much money it makes, and how cash flows in and out. But what are financial statements? What do these statements actually include? Why are they so important? In this video, we'll break it down step by step, covering the three key financial statements: balance sheet, income statement, and cash flow statement. Section 1. What are financial statements? At their core, financial statements are reports that summarize a company's financial activities. They help businesses, investors, and even the government understand how well a company is doing. Think of them as the report card of a business. Just like students get grades to show how well they're performing in school, companies use financial statements to show how well they're managing money. There are three major financial statements, each with a different purpose. Let's start with the balance sheet. Section 2. The balance sheet. The balance sheet is like a financial selfie. It captures a company's financial position at a specific moment in time. It tells us three things: assets, refers what the company owns, like cash, buildings, and inventory. Liabilities, refers what the company owes, like loans, unpaid bills, and salaries. Equity, refers what's left for the owners after paying off debts. Here's a simple equation that explains it all: assets equals liabilities plus equity. For example, let's say a company has $500,000 in assets and $200,000 in liabilities. That means its equity is $300,000, which belongs to the owners. The balance sheet helps investors and business leaders see if a company is financially stable or drowning in debt. Section 3. The income statement. The income statement, also called the profit and loss statement, P&L, tells us whether a business is making money or losing money over a period of time. Here's the formula: net income equals revenue minus expenses. Let's break it down. Revenue, the total money a company earns from sales. Expenses, the costs of running the business, like rent, salaries, and materials. Net income, the final profit after expenses are deducted. For example, if a company earns $1 million in sales but spends $700,000 on expenses, the net income is $300,000. This statement is crucial because it tells investors whether a company is profitable or struggling to stay afloat. Section 4. The cash flow statement. The cash flow statement shows where the company's actual cash is going. Unlike the income statement, which includes non-cash items like depreciation, the cash flow statement tracks real cash movements. In general, cash flows are divided into three sections: operating activities, cash from the company's normal business, like sales revenue and paying suppliers. Investing activities, cash spent on or earned from investments, like buying equipment or selling assets. Financing activities, cash from loans, issuing stock, or paying dividends. For example, if a company has $500,000 in profit, but it spends $600,000 on new equipment, it could face a cash shortage. That's why investors and business owners pay close attention to cash flow, because it determines whether a company can pay its bills and survive in the long run. Section 5. Importance. Financial statements are critical for the following reasons. First, investors can use financial statements to evaluate a company's profitability, financial health, and cash flow before deciding whether to buy, hold, or sell its stock. Strong earnings reports can drive stock prices up, while weak reports can cause them to drop. Second, banks and lenders can analyze financial statements to assess a company's ability to repay loans. They look at profitability, debt levels, and cash flow to determine whether a business is a safe borrower or a financial risk. Third, business owners rely on financial statements to track company performance, control costs, and plan for future growth. By analyzing sales, expenses, and cash flow, they can make strategic decisions to improve profitability and sustainability. Fourth, governments and regulators use financial statements to ensure businesses comply with tax laws, protect investors, and maintain financial transparency. Accurate reporting helps prevent fraud and economic crises, ensuring trust in the financial system. Section 6. Summary. To sum up, financial statements provide a snapshot of a company's financial health, detailing its assets, liabilities, profits, and cash flow. This video covers the balance sheet, income statement, and cash flow statement, explaining their roles in tracking financial stability, profitability, and liquidity. Investors, banks, business owners, and regulators rely on these reports for decision-making, making financial statements the key to understanding business performance. Alright, that's all for today's topic. If you find this video helpful, don't forget to like, subscribe, and leave your comments below. Thanks for watching and I will see you next time.